The goal here is to really get you to think more about what a lender is going to go through as an exercise when we're looking at financing commercial real estate, which is a lot different than Mike's. We go through everything that Mike does as well to try to come up with the value, just not in the detail that he does. But there's a lot of, in residential, you have a tendency to think of, okay, a 43% debt to income, this is how we get there, this is the appraisal. There's a lot of nuances to commercial lending because commercial properties are not the same. Whether they're owner-occupied, I heard some really good questions back here about cap rates on owner-occupied versus vacant. Naturally, an owner is going to have, depending on location, maybe more income generated from what his business is. Certain things like that we think about. And this is our underlying philosophy. Loans are made with cash. It's our cash we're sending out there, and they're repaid with cash flow. How much revenue can that business or that real estate generate to repay us? And that's all we're really thinking about. That cap rate Mike was talking about, and a good question in the back, simply put, the lower the cap rate, the higher the value. It's an inverse relationship. You know, and you think about it, somebody mentioned, I don't know if it was Josh, about, you know, what return would I get if I paid cash for the property? That's all a cap rate is. And that competes with what return I can get if I invest in treasuries or if I invest in any other, a mutual fund. And what's more risky? We're seeing a very low cap rate environment right now, which as a banker concerns us because how much lower can they go? Although Europe's experiencing negative yields right now, which is an interesting philosophy. We'll see how that goes. If I give you $100 today, I get 98 bucks back next year and I'm happy with it. We haven't seen that in the United States yet, but caps are low, which means values are high. Bankers think about that. How do we get to cash flows? Now, I put a bunch of worksheets in the back, similar to what Mike's are, and you're welcome to utilize them. They're primarily Excel, and we tweak them as we go. And there's different types of businesses and what we use for an underwriting tool and how to calculate that cash flow. How are we going to get repaid? That's all we're concerned with. And the last thing we want to have as repayment source is selling that real estate and having to come back to you guys to market it. We have expenses when we own it, like insurance and taxes and things. That's not what we're interested in. We're not in the real estate business. We just evaluate that cash flow. A traditional cash flow, IPP, Mike kind of hit on, is an income producing property. As Josh's question of, if I'm just a tenant, I got a triple net lease, I'm collecting my payment, we're going to use what's called an income producing property economic sheet, which is basically the exercise Mike just went through, only it's going to be, here's my rent, here's my taxes, here's my insurance, here's a vacancy, and I'm going to come up with, okay, what's my net operating income projected going forward? And we're going to take a cap rate, we're going to come up with a value. But we use that net operating income a little bit different. We use it in ratios to tell us how secure we are on how much leverage and debt level we have on a property to get repaid. We'll get into the debt service coverage ratio, but you'll hear that a lot in commercial circles with lenders. In essence, it's simply the inversion of a debt to income ratio that you probably are used to with residential, debt to income. Well, simply invert the ratio and you'll come up with debt service rate. If the NOI is $125 and the debt is $100, then it's a 1.25. And all it really means is how much cash can that property generate, or are we going to require it to generate actually, to pay $1 in debt? I mean, and if you just simply take the numerator and denominator and invert them, you'll come up with a debt service ratio. It's not any more complicated than that. Business cash flow. We don't see much of this in the keys, so I don't want to bore you with a bunch of ratios, but traditionally, let's say I have an operating business. I manufacture something. I'm really working. Then there's a separate cash flow worksheet, which is called the Uniform Cash Flow Analysis Sheet, which takes into account changes in not just my income statement, how much my sales, how much am I getting, but it also incorporates that balance sheet, which is going to have my cash on hand, my changes in inventory, my changes in liabilities, because the bigger you are, you think about cash flow and repayments, there's a lot of things that can generate cash flow for a business that's not just selling a widget and running it through the system. I can borrow money to create cash flow. I can convert inventory and discount. Leverage is probably the easiest one, but I also can make changes on my payables and my receivables and other things that incorporate a source of cash for the business owner to utilize. A common philosophy is simply stretch your payables. If If I have accounts payable out there, well, I'm not going to pay them this week, I'm going to pay them in 30 days. That's actually a source of cash that when you roll through a uniform cash flow analysis, we pay attention to. And you just, like I said, you don't see much of it in the Keys because you really don't have any manufacturing or strong retail growth businesses. What we have is primarily hospitality, tourism related. There's not a lot you can do on your balance sheet to give you a source of cash. You're selling something and then paying a bill. But I provide it in the back for you to look at it. I say in my career, I can think of about 3 of them in 30 years in the Keys where it's really a manufacturer, where we pay attention to that. Traditional cash flow is what you'll see more, the business cash flow, which is an income statement sheet, which is in the back, and then we get to what we call the debt service coverage ratios, which I just explained is simply how much does that business generate to service $1 in debt. And that's not just my debt, it's all debt. You know, there could be other equipment loans out there, or car loans, or this, that, or the other, that plus whatever they're buying, that hopefully you're selling them, and then I'm financing. We're going to look at all the debt. That's one thing that's interesting with the cap rate type analysis. You're only looking at a specific property. We're going to look at all debt. And then the balance sheet, as I said earlier, we don't have a whole lot, but there are things like you'll hear quick ratios, current ratios, tangible net worth ratios. Accountants all love them, and they all have very good purposes to tell you something about the business, but you're probably not going to run across too many of them down here. If you do, I'm going to leave a stack of my cards. Feel free. I'm sure you've got some accountants. Brian knows most of those ratios probably too, but you're not going to experience a whole lot of them, but I wanted to provide those for you. Sometimes you hear the 5 C's of credit, and we'll go through them. From a lender standpoint, we look at all 3 of these: the character, the capacity, the collateral, the capital, and the conditions. Best phrase I heard in the last downturn was we got away from loaning to people with good character and loaning to characters. That probably did sum up a decade ago as we were all living through the environment. In parentheses there I put really what it matters. You know, the character we judge with the credit bureau. Do you pay your bills? Capacity is really the income stream. The collateral is whatever piece of real estate we're looking at, or in some equipment, etc. Capital is how much they're putting in it, and how much do they have on their balance sheet to utilize. You know, if you pay down stuff and you've grown a business, a lot of times you may have a significant net worth, just like an individual may, that he can borrow, get something else to help. We pay attention to that. And conditions are how we manage that repayment and that cash flow going forward, because we will want to manage the cash flow going forward to certain parameters, mainly to protect the borrower from us and also to protect us from our regulators. Stepping into understanding that borrower, these are the questions and thought processes that a lender is going to go through, very similar to what you probably do when you interview a client to get a listing. Who they are, what they do, who's the management, and what's the ownership structure. You know, are they absentee and have somebody running their business down in the Keys that they're paying? Are they more hands-on? What's their competition? What's the environment? You know, this nice thing about the Keys, you have very strong barriers to entry for competitors. You don't really see a whole lot of new people coming into the market because it's expensive and it's regulated. And so really that competition analysis is more on who's anybody. How many boat rental guys going? How many hotels? What's the overall capacity? We're going to look at all of that. An on-site assessment. You know, I tell all of my lenders, you know, go out, kick the tires. You need to do the interview with the client on site. They'll feel more comfortable and they'll be more disclosive to you about what's going on. And when you talk to them about who do they perceive their competitors are, you learn a lot by going through that. And past borrowing and repayment patterns. You know, that's on a business, we have what's known as some business credit reports now. There used to be the Dunn reports. Now there's all kinds of different ones that are available for us. But as primarily down in the Keys, you'll find us just running the credit report of that owner of the business will tell us more than we need it. We'll evaluate, you know, what are they borrowing on? What's the purpose? What's that collateral? We always like to see more than one repayment source. You know, if your primary repayment source isn't the operations of the business or the cash flow from that real estate, you probably should be looking a lot closer at what we do. Now, a lot of that will be sale if you have developments in real estate. developers. We'll get into some of the calculations we look at there later. Secondary would probably, the majority of the time, be other sources of repayment streams from the business owner. And then tertiary is probably sale of that collateral, because like I said, loans don't get repaid with sale of collateral or foreclosures. We don't like that, so we just like cash flow. All banks have a loan policy. Most of them are fairly similar, but there are nuances depending on what your specialties are. And the thing that a lender is always going to be cognizant of is, do we have any exceptions to policy? And if we do, we're outside of our normal comfort level. Doesn't mean we won't do it. It's very common. But how do we mitigate that? And other ways and strategies could be additional collateral they own, another piece of real estate, along those lines. Financial condition. Balance sheet and income statements tell us pretty much everything. Trend analysis is very big to lenders. Mike was talking about sort of a snapshot of here's what I'm going to look at. We like to look at over the last 3 years. What do those trend lines look? Are sales going up? Are sales going down? How are our operating margins coming? Are there any new expenses? Wow, all of a sudden my property taxes and my insurance go up. We like to track those lines and kind of pro forma out on trend analysis more than a snapshot of an income statement that the appraiser is going to use. So we always like to see at least 3 years worth of numbers, whereas an appraiser may only want this year's numbers. We're going to want to take a look at what's going on with that business. And what it really tells a lender, the number one criteria is management. Does that owner know how to run that business? And you will see that looking at a trend analysis. Projections and pro formas, I put in here, and that's sort of a four-letter word. Anybody can do a pro forma with an Excel spreadsheet that tells you exactly what you want to know, if they know what the question is. So we have to stress that stuff and really look more internally than we rely on business projections of the vacant building. We go through a lot more exercise on that. And once we have those trends and what we call spreads, there's all kinds of good software anymore that just does that for you. Then we'll start doing an analysis of that cash flow. And the real question is, how stable is it, and how do we think it's going to be going forward? Projecting out a trend line. Are there challenges in the environment that's going to competitive that may impact their revenue, or are they just so well positioned? Also, are they growing that business? Are they opening new locations? Are you selling them something really great that's going to go with? We'll look at that on that analysis part. And along with that growing, as you sell them stuff and we finance it, what else are they going to have to utilize in order to run that business? If they expand their locations, it's a lot more than just real estate. Do they need equipment? Do they need trucks, boat rental fleets, restaurant equipment? These are the things we see a lot of. And what are the borrowing requirements going to need to be for those? And if I'm not financing it, what are those repayment criteria going to be for the leasing companies or somebody else? That's going to be very important to your lenders. Let's see, repayment risks. And this is, the borrower risk really is management. We all have been down here long enough, that a lot of things can come up unexpected. There could be health concerns. There could be a lot of things that go on in the keys that impact the management. Do they have succession plans to run that? A lot of the stuff we look at here that's smaller properties in the hospitality sector, saying there's real issues, and we all know it's hard to find employees down here right now. That borrower risk from management is really what we're talking about there. And we love multiple sources of repayment. You don't get to see it that often down here. And then the mitigation strategies, like I said, if we're looking at succession planning on management risk, do they only have, is it a 3-employee shop? Or is it a 100-employee shop? And do they have adequate management in each division? Here's a prime example of a beautiful property, but it took them a long time to staff up, as we all know. That impacts cash flows, that impacts valuations. We need to be cognizant of all of that. Guarantees, non-recourse is something that we always get asked, and a lot of people, you'll hear that mainly from outside folks looking, because it has been more prevalent lately in the competitive environment as lenders get a little stupid, candidly. And it's competitive, and we all want to make loans and make money, and what am I going to do, buy a bond at 2% right now? With it just, and borrowers know that, and borrowers will come up and say, okay, how can I push the envelope? And can I get that lender to agree? There's nothing wrong with asking, but sometimes there's a lot wrong when a lender says yes. And right now we're seeing a lot of yeses on competitive urban markets primarily, and the regulators are looking at that. But in the Keys, I don't think there's any of your banks down here really doing non-recourse financing. So if the owner of that business doesn't want to sign personally, that should be a very strong red flag indicative of their lack of faith or willingness to do that. Outside sources of repayment really come if they have additional real estate and additional businesses outside the market, or if we have that guaranteed, or they have other investments. Other debts, priorities, and subordinations come into play. What other obligations they have that's not with a banker? What's their total debt level? The qualifications are going to be similar to what we went through with the 5 C's. Credit history, it's usually one of the last things that I do with a borrower, to be honest with you, is the credit report. Nobody likes having their credit report dinged and it impacts, and I just sit them down in the initial interview and say, I'm assuming if there's anything in there that I'm going to find out, you'll be disclosing it now, because tell the truth as fast as you can. And usually that works. But we are going to run it. We are going to pay attention to credit scores. We are going to pay attention to past credit streams. But it's really not as front and center as it is in the residential world, because it doesn't really tell us a whole lot. We're looking more at that business and that real estate than we are looking at what the W-2 wage earner's credit history says about them making payments. We do look at the personal spreadsheet. That's basically their net worth. It's very similar to what you would see on a residential real estate application that you're probably all seen, the 1003s. What's your net worth? How many assets do you have? What's your liabilities? What's out there that adds strength to mitigate any risk we may see? Residency is a big one down here. Do you have a residency down here and market knowledge and management ability to run a business? A lot of people like to buy their way in. I used to think of Running Scared was an old movie back in the 80s with Billy Crystal and Gregory Hines, where the Chicago police retired down to Key West and bought themselves a charter fishing business, I believe, and were roller skating down Duval, and they actually used an old co-worker's of mine desk at the old Southeast Bank which is now Ripley's, in that movie. But we get a lot of that in the Keys. I'm going to come down, I'm going to buy myself a job for twice the hours for half the money. We have to know, do they understand the market, and can they run something here? Because it is not easy to do that here. The business, after we're done with the personal, we're going to look at that business. What's the ownership structure? Is it a corporation? Is it an LLC? Is there 10 owners involved, or is it 2 or 3? In the go-go days, we saw a lot of partnership issues cause some problems for bankers, and bankers are very concerned about that today, where if you have a property, you're selling somebody $1 million property and they put $200,000 of their own money in it, they might be a little more attentive than 10 guys putting $20,000 in. And that's really where we look at that ownership structure. As we talked about earlier, what separates that business in location, reputation, longevity, expertise, and management. Here we see a lot of economic and regulatory environment. We still have a strong commercial fishing industry. That's one that we're very cognizant of, the changes there. And a lot of that comes into that interview, which I said earlier. We try our darndest to do that interview on site. This one's big in the Keys. Construction lending comes with its inherent risks, and we'll just briefly go over the mechanics lien law. Always protects the contractors, and bankers are very concerned about that. The notice of commencement, or NOC, it triggers all of that, and who gets lien priority, and what risks do I have to think about when I'm in construction lending. We also have to approve contractors. A lot of people don't think about that, but that contractor balance sheet, which, by the way, there's a whole application package that includes their financials and their history, and We don't want, we try to protect the owner from that contractor a lot of times. When you're talking large commercial, primarily stuff, you may look at the size of the property. Does it need to be bonded? Does that contractor have bonding capacity to make sure if something goes off the rails that somebody's going to step up and pay to get it finished? K-Lor was a prime example. For those who were in the Upper Keys market, remember when the contractor walked off the job and the bonding company had to come in and pay somebody else to finish it? Trust me, the lender was not happy about going through that process. Entitlements, y'all are very well versed in that. So I don't think we have to go through, is it an entitled project? How long is it going to take them to get some entitlement? Which of our municipal or regulatory bodies are they going to have to deal with to get through that process, and do they have somebody on the team to do that? And that all comes into that regulatory and entitlement. Construction lending is the valuation process can be a little more difficult, because there you really are into a pro forma basis. You don't know what the fit and finish is really going to be. You don't know how long it's going to take to stabilize an income producing property. How long is it going to, it's one thing, as Josh was talking about, vacant. It's another thing, if it's a new product, hopefully it will attract attention and maybe my lease up time will be less. But that's all going to be drawn into Mike's calculations over there on looking at values and projections and cash flows. And he's got a slew of formulas he uses that we have to be cognizant of. Construction draws, we manage that risk. Most contractors like to use your money and not theirs. We try to do it the opposite. Let them deploy their money, and then if it's satisfactory, we'll reimburse them. That protects you. Change orders, cost overruns, certainly we're looking at those hard and looking at the types of contracts you have in construction lending. GMP, guaranteed max price, you have a cap in essence. But those ones above that, change orders, always gets around. For some reason, always gets around that stuff when they really get done more in government. A cost plus contract, what allowances do you have in those build outs? All things we're going to look at. We're seeing more and more over the years the investor coming in rather than the owner-occupied business owner and looking at our commercial properties. These are just, there's some of the different types. You have the income producing, the owner-occupied, the vacant land. But when loans for commercial investors coming in, especially our larger properties in the Keys, which you probably would be amazed at how low some of those cap rates we're trading for in certain markets because we have strong barriers to entry. Who's really financing those? It's not your bankers. Those larger ones are being financed primarily sourced through insurance companies, syndication, a mezzanine partner, which is simply a subordinated debt person who will come in for both a guaranteed rate of return on his money as well as a piece of equity. And the REITs certainly came in and bought up a lot of our hospitality in the capital markets is where they're getting their financing. So a lot of that, from a real estate perspective, as the realtor, I think when that CFO of whoever that out of area buyer is, they're taking care of that. I really wouldn't worry too much about it, but they are here. They're very active in our market, especially for our larger commercial properties. A&D, acquisition and development loans. We'll see how many of them we do in a few years. But we certainly do a lot of them today, and they are just your income producing, your multifamilies. What are we looking at with them? Is that appraisal piece is very big in our A&D. I missed part of Mike's as I stepped out on. We got absorption rates and timings of cash flow and things like that. We're gonna look at on a lot of these A&D loans. The bulk sellout. That's what that DCV is a calculation that the appraiser will go for, that we'll also nitpick and say, okay, do we think you're going to sell 6 units a year or 12 units a year of this project? Because it all comes down to cash flows, as we said earlier. When are the timings of those cash flows? When do they come in? How reliable are they for the banker to say, I'm going to get my money back? Zoning, entitlement, regulatory risks, also part of A&Ds, as well as almost any construction loan down here, period. And they're a lot of times we can have some delays due to unexpected hurdles to be overcome as you go through the building process and the permitting process and the keys. We always have a tendency to learn a little bit new as somebody decides this is the issue of the week that they're going to pick up on in the regulatory world. Portfolio loans, once we get through all of this, and let's say we're happy, we know the project, we know the management, we know everything else, what really type of bucket are we going to put in? And these are going to be the parameters that probably you need to think about the most. And this, I tried to put just one little shot, because this is going to come on to how much equity do they have to put in the deal? You know, that's going to be the key. They all want to, you know, try to do a 90% deal. That's very unheard of in the commercial sector, whereas it's common. You have 97 on the residential side. CRE is an acronym. You know, they're commercial real estate, and then HV is highly volatile commercial real estate. It's a new regulatory definition, which basically is a construction development loan with anything less than 15% of cash in it. And there's some calculations that appraisers have to do, and we have to look at, and where it affects a banker is it affects our return, because we'll have to reserve more money for the life of the loan, by the way, not just for until it gets back into proper loan to value. So they're priced a little higher. That's really the takeaway there. But for the most part, you're going to look at 75 to 85%. If it's a professional owner occupied, you see 90. Sometimes there'll be 100% LTV out there for the right professionals. You know, that bankers are always famous for putting out that, hey, doctor loan program, where I'll finance 100% of your house, and I want to lock you down. But for the most part, professional space, lawyers, doctors, and well, they can get away with the 10% down, but they're about the only ones who can in the market. In general, it's going to be a 75% loan to value. Commercial and industrials, a little bit lower, because there's more inherent risk in it. Therefore, the banks want to make sure you have sufficient skin in the game, so to speak, to continue to be willing to make that payment. The acquisition development loans, we're going to look at probably interest-only periods, 2 to 3 years. We're going to look at the discounted bulk sellout basis for our valuations of 65%. That is simply, Mike could probably speak more to that, about some other calculations involved in rates of returns and discounts over those timings of cash flows. Typical loan terms in the market, you'll see 10 to 25-year amortizations, fixed or variable. Typically, whether that's Centennial, BB&T Capital, First State, you know, we're all kind of in the same general loan policy buckets that regulators approve, and those are going to be maturities out there, typically with no more than 10 years. You'll find more, maybe 15 years on that owner-occupied professional stuff, but for the most part, it's a 10-year mature balloon payment with loans on up to a 25-year amortization. Now that we're seeing lower rates and higher values, most lenders are starting to ratchet back to 20-year amortizations, just so you know. Because we're concerned about where do we go from here, and we'd like to see more of that cash flow coming back to us sooner. So we're really kind of staying away from 25s. You'll see it on certain asset classes that you don't really have here, apartment complexes, things like that. Maybe you'll still get some lower debt service coverage ratios and longer AMs. Those debt service coverage, you know, that's once again the inversion. It's how much money does that property generate to pay $1 worth of debt. We'd like, at a low end, it's going to be $1.15. Those are more for the stabilized cash flow properties, you know, multi-tenant rental properties. You know, you're not going to have a whole lot of problems keeping them leased up here. You know, with the cash flows are going to be very stable. Then maybe we'll lower that debt service ratio down to a 1.15 or a 1.2. They'll go all the way up to a 1.5. You know, if there's a highly competitive environment with a lot of cash flows from operations involved, we may want to see a little more cushion in those cash flows to absorb market changes and impacts. And that's what you really need to think about when thinking about a debt service coverage. The higher it is, it really just means we're managing risk for market forces. Nothing more than that. And you know, a 1.2 debt service ratio, just to give you an idea, it's really like an 80% debt to income, okay? So if you're thinking about it with your residential hat on, there's not a lot of room in there for additional hits, whether that be to income or expenses. And then A&D, the acquisition, development, construction projects, we're going to look real hard at pre-sales before we let you start building. We'll want to see that sales office out there with the Caldwell Banker sign and y'all working and bringing up some contracts and reservation agreements before we're going to let it come out of the ground. And we're going to talk real hard with the developer about that on the release prices, because that cash flow should come to the lender first, and then they get to sit out there at the end and make all the profit. And they'll always want it the exact opposite. It's a conversation that we have on a regular basis. SBA loan programs are getting more and more prevalent in the marketplace. There are some regulatory eyeballs on this right now, so I just wanted to give you the summary of what's out there and what the general parameters are. In a nutshell, you're going to pay a higher rate, and you're going to get a government-backed program, which banks love to buy on their investment portfolio. But originating them, you pretty much have a lot of servicing risk and a lot of risk on the origination side that you have to have specialty shops on the SBA. Now, there are banks have gone out and bought a number of shops. Iberia, for instance, bought a specialty firm out of Orlando. BB&T's got a specialty firm, so does Centennial, that does nothing but SBA lending. The theory from a government standpoint always was you used to have to get a declination letter in file before you got to an SBA loan. In other words, we'll come in there and help the small business guy if the banks won't. Well, that piece sort of has been missing a lot, and that's where they're coming down on their inspections and regulations to making sure that, look, it's a fee income-based business, similar to what a mortgage business was. It's what's left, so banks went after it to say, I'll just get fees out of generating government guaranteed. And they forgot that, hey, if I'd actually do that loan without the guarantee, perhaps I'm required to do that. And we're going to see some increased audits from the SBA. And don't anticipate watching that wave go up and down. And it's probably going to start going down in the next 4 years or so. But they're great programs for a borrower who doesn't have a lot of cash and is willing to go ahead and pay the rate and the fees in order to get it done. Josh, did you have a question there? I saw your hand going up.
Did you say that they still require the declination letter, or they're getting away from it?
They never removed that from the regulation. They just got away from it. As an industry, I'm telling you, we all just said, okay, let's go sell the SBA and strip the fees to originate it, to service it, to sell it, to, all tattletale on our industry. And but they never removed it from the requirement. It's still supposed to be the risky loans who couldn't get serviced under normal channels. And one of the things we've always done is sort of say, well, it's that LTV issue. But you better dock the file, and we got away from docking the file. So,
yeah, how long is it taking to do a 504 loan?
Depends on which shop you're doing and how good they are. We don't originate them. I've seen them done as quick as 45 days. I've seen them done in 6 months. It just depends on how responsive the borrower is going to be to the requested documentation.
But assuming all the docs are in, everything's in place, in terms of that, and the file's complete and funding, what are you seeing on that?
If you're in a very good shop, 30 to 45 days, you can get it closed. But that's everybody knowing what they're doing, and that doesn't happen but 10% of the time, if that. Give yourself 90 to 120 days, and you're probably closer to what the market's going to be. Because they're always going to find some last thing that needs to be initialed or completed the file. These are the general. CDCs are involved in that 504s. The 7A programs certainly more and more prevalent. High limit, so you can go through the general qualifications of them. The program requirements. The owner occupancy is probably the real key. The SBA program is designed for the business owner, not for investment. And they'll do equipment, they'll do real estate, they'll do construction. You can pretty much get anything you want done through them. Okay, well, this is where I kind of incorporated these spreadsheets last time in as we went through it. I know we kind of walked through quickly because we kind of lost some people last time. So we'll go through really, these are the tools that the bankers are going to use. These Excel spreadsheets. Personal spreads, as we talked about, evaluating our owner of that business. How strong are they financially? And this is just a basic cash flow analysis, and it gives you an idea that a lot of it, you may not think that bankers pay attention to, but living expenses, taxes, other adjustments, tax exempt income, all of that comes into play for us to get a cash flow. Is it recurring? Gains on sale of stock, capital gains. We see a lot of that down here, especially with sophisticated investors buying real estate. How predictable is that to be recurring, or is it a single source? And we're going to adjust all of those things out. So when you look through each of these line items, you'll see these are the items that really hit the tax returns. And then what do we do with them? Are we going to keep them, or are we going to throw them out when we figure out what is the probability of recurring income levels? And there's nothing set in stone in the commercial world. Okay? There can be, hey, I'm a sophisticated real estate investor and I have 3 years worth of capital gains and I'm flipping property, so maybe I will give you credit for it. But the formula here is immediately going to say I don't. Mike?
One question, Jeff. When you see a big disparity, looking at the bottom line numbers there, obviously you're going from 28,981 up to 1,196,000. So when you see that type of disparity from one year to the other, does that raise any alarm?
Well, it goes back to our trend lines, and if you look at the trend lines, it's really telling me they're doing well. But yes, it raises not necessarily an alarm, but it raises an indicator that I needed to delve deeper, and then get a feeling of, are they in the right direction? Really, what's driving that last number is a distribution. And see, we look at things that may not go to a tax return. Just because my company only made $100,000 and it's an S corp, I'm going to flow through $100,000 worth of income, right, in order to pay. But maybe I did something else. Maybe I borrowed money or did something, and I could distribute cash out, and that's what happened here. I only made $700,000 taxable income, but I end up with $1.2 million because I distributed cash out on that distribution line. And then we'll delve more into, okay, what company did that? How did it do it? Is it going to be recurring? Because that's a little bit different. Most of them you'll see the capital gain numbers really jumping up and down depending on market conditions. But in this particular example, you'll see that plus sub-S distributions. And that can also be negative, by the way. Say I had to contribute capital to my company in order for it to expand and buy something. That's a source of cash. And you'll see that on a K1 statement. That's where all of this comes from. And those are very important. You'll see a lot of times the commercial lenders will ask their commercial clients, give me the K1s. I don't just want the tax return. I want the K1 because it tells me what levels of cash is that distributing to me and what levels of cash do I have to contribute to it. Sir?
When you see 3 years tax returns, are you going to come up with an average of those three? And then the other part of the question is, are you going to also look at trailing 12 months, or are you going to look at the last year's tax return?
We are going to not average. We're going to calculate that income basically, self-employed, residential, they like to average. Commercial guys, no. We're going to look at this and say, each year, how did it look? When it comes to trailing 12s, that really depends on the business. You can get skewed a lot of trailing 12s. When people want us to look at that, we're going to look real hard at insurance payment timings and tax timings, and did they pay them? Because those are the ways you can get trailing 12s to look good. If you're a new business and you've come online, hospitality assets, etc., that trailing 12 number is very important. It's very important for us when we manage our covenants, the debt service, more so than when we're underwriting. Typically, we'll have a year-to-date, not a trailing 12, because we'll already have a year-end number. So we may have a separate column out there that's a year-to-date number, whether that's quarter, the first quarter or the second quarter, 3, 6, 9 months to look at the trends. But we'll also look at timings of expenses on that income statement that can impact how skewed it looks. But for the most part, we do it as a snapshot over each year with no averaging. But good question.
You mentioned that you said with 3 or 4 years of continuing sales of capital gains, you might start to count that.
Absolutely. We'll take a look at their investment portfolio. I mean, they sell it all, or do they have continued sources? Is that a reliable, recurring source of income? That's going to be the question. And it'll be subjective when we come up with that answer, because it doesn't mean they sell anything, but do they have the capacity to sell it? Next up, we're going to take all of that income and we're going to take it all under their debts, and we're going to come up with both a debt-to-income ratio and a debt-service ratio. I love this personal calculation because we talked earlier. You can kind of see, okay, depending on how you look at it, and you'll notice that it's not really the same, like a 135 and a 34 when I said earlier, or a 1-2 is more like an 80%. The reason that comes into play is that when I talk about a debt to income ratio, I'm really not making any adjustments to the cash flows. I'm going with that AGI number. Whereas I'm talking to a debt service coverage ratio, that's when I'm looking at the distributions, the living expenses, the income tax, all of that, those expenses that somebody have. And if we go back, you'll see all those adjustments. That really comes into play for the debt service coverage ratio, whereas total income is really what's coming into play for a debt to income ratio. Did I lose you there? Or? But if you're thinking of residential, which everybody knows when they apply for their mortgage, how they calculate things, and look at that form that you fill out, that's the debt to income. And debts are debts, you know, where do we get them? What's the payment level? But it's pretty much the higher the debt service coverage ratio, the more comfortable I am with the loan. The higher the debt to income ratio, the less comfortable I am with the loan. You know, and that's just it. But let's say I'm retired and I have, maybe I'm managing my taxable income the way I should. The balance sheet's the next thing we're going to look at, and what sources are out there for us to get repaid. You know, and this is just a general synopsis. It says, okay, here's all my different businesses. What percentage of them do I own? You know, that's very hard to pierce from a lender standpoint. It's nice to know you got them and they provide you cash flow, but can I get to them? Probably not. So we do what we call an adjusted net worth after we go through this exercise. What am I really going to have access to, or ease of access is probably cash, securities, 100% owned real estate. Those are the things that I can count on to maybe provide cushion to get repaid. And then we come up with a debt to worth, very similar to in the business world, if it's the business balance sheet, what we call a tangible net worth ratio. Figure 0.3 and under is really strong, and above that we'll start looking. You can see this person got a very low debt to worth, so that's a good indicator of their ability to convert assets to repay debts. Because that's a source of cash flow, as we talked about earlier under the UCA. Here's Mike, A&D lending. You know, this is the A&D revolver and how we're going to get paid from the construction loans. It's not as prevalent as it used to be in the go-go days, as it's harder to get entitlements and to go ahead and build the projects, but certainly on the mainland this is more germane to what we do on a daily basis here. And this will just give you an idea of what we look at on sensitivity analysis. What's your average sales price, the number of those units, what's the project budgets, and how much cash are we going to get in there. And as we flow through this, that stress column of bulk sensitivity, you know, it may be 92 units that are going to sell for 32 million, but as we stress those cash flows over time, you know, what really is a valuation number we can count on as a present value number, and how's my loan to value get impacted as I stress these things. This is a good source for y'all to look at if you ever come. Feel free to call me if you've got a development deal and want to go over it more so, but they're not as prevalent in the marketplace, that's for sure. But a traditional cash flow is. This is where we get our debt service coverage ratio. It's not rocket science. It's, you know, how much is the net income of that company? I can add back non-cash expenses, depreciation and amortization. Sometimes we don't add back the depreciation number. It depends on the operating business. Let's say I'm running a rental truck fleet or a boat rental company. Guess what? I'm writing that depreciation off, but that boat's not worth the same in 5 years. So we're going to probably look hard at that depreciation number and know that there's some number that's going to be just waste in that operations of the business and not add it all back. But those are heavy equipment intensive businesses. Certainly real estate, what you see down here, we're going to add it all back. And we'll look at reserves to do maintenance. Interest expense, and then there's that distribution number. Just because that company made money, we're going to take a look at, did they distribute money out on the K-1s? Did the owner take money out to spend somewhere else? And then we're going to go back to that personal, and we're going to say, did he need to do that, or was it simply something they could do? And is it required to fund their personal lifestyle?
Can we go back to that last sheet there,
Those are the expenses to the loan. We're going to require an appraisal. You got to get paid.
No, but I think that's too low.
Oh, you know, you have a better lobby than I have because you're going to hit it on the origination fee, and you're going to get paid because I got to get you. So, but certainly in a project of 200 units and going through that, you know, everybody thinks their appraisals fees, you know, they can range dramatically based on the complexity of the work we're going to ask Mike to do. And we will go ahead and bid that out. Now, all of this after the last downturn, so you understand how banks work. We have separate appraisal departments. We're not allowed to talk to the sales origination guys. We don't even know who the appraisal has selected. All we know is they're going to go bid it out. Some of them are using great automated systems. I know Mike's probably on RIMS and some of the other ones. We don't use it personally, but it goes in bids, and you get a time frame and a cost, and we pass it on to our borrower who says, okay, I'll go with that. We don't know who it is. We don't know. All we know is that who's bid on it is on our approved list. Now, people in my appraisal department know all this stuff, but they won't share it with me because, God forbid, I get to talk to the appraisal and give them some information that may impact value. They want it to be completely independent. You comment on that, Mike?
Well, yeah, the thing is no, they don't want persons like yourself and me communicating with each other, but because what they're trying to do is avoid any collusion in that respect. But I think it cuts out a very important step because things that you and I can communicate on really help to create a seamless platform as we move through the process.
Absolutely, and it causes delays and it causes a higher cost. Well, if my
Our appraisals out there, we know that might happen with it. So.
Yes, the made as instructed appraisals that we got back in the day, that bankers, we don't have clean hands on that, okay? I'll be honest. And that's why we have this extra step, and it does take time, and it adds cost to the project. But it does, more than anything else, probably protect the borrower, which is what they were after. How are we doing on time? We're good. We'll just wrap through these income statements. These are very similar spreads to what you see we're going to look at. And what are we really looking at? Trends. That's going to tell us anything else. How well, and that tells us how well do they manage the business. Because once again, management's number one when it comes to commercial lending. That's where there's expertise to generate cash flow that pays back that loan that was made with cash. And I'll see that on trends and how well do you manage through a business cycle. We love lending to developers or business people that went through the last cycle. You don't want to lend to somebody, well, I didn't say you don't want to lend, but you're going to be more cautious lending to somebody that came up in a high growth environment where the economy's just churning along and they never had to overcome an obstacle and they're fresh out and voila, you're going to loan. I really like the management guy who's been through a business cycle. They know how to survive and they know how to repay their loans because they understand they'll probably need access to credit again. And those will tell us that. Certain things I highlighted here that are the non-competes, you don't see too much, but we'll adjust for those. We're going to keep an eyeball out for any unusual expense items and whether we have to adjust to them or not. Yeah. And you can go through the spreadsheets and kind of just see how we calculate this. What line items are we looking at? Because it's a lot more complex when we look at it than a traditional consumer debt to income. This is the UCA cash flow we talked about before. This really tells us what are sources of cash for a business guy to use running them. You know, changes in receivables, changes in inventory, payables. Those are all sources of cash. He gets it from selling things, he gets it from trading and financing, he gets them from operations, and then what it should reconcile at the end when I look at the balance sheet and the income statement to what actually changed on his cash line item. And if it doesn't, we're going to really go in there and see, are these reliable financial statements? What are we going to do with it? We're going to take a look at their current portion of long-term debt. This is another way of looking at what debt levels a company, especially when they have a lot of debt and they're running. You know, do I need to know every single payment for every loan? Not really. I can probably take a look at the current portion of long-term debt on his balance sheet and his interest expense on his income statement and know exactly how much he's got to pay on an annual basis. So when we're looking at it from a uniform cash flow analysis, using that additional information in the balance sheet, we can really dial in pretty quick. And we can look at change in equipment and vehicles. That means he's buying things he has to run the business, or she. and what changes in those fixed assets. And we love that last line there, financing surplus or deficit, because that gives us an indicator of, hey, he's growing his business and I can get out there and sell to him. If we like him, we want him to actually need to borrow. And then there's your total financing to balance it all to ending cash. This one you'll see a lot. I heard some questions earlier when Mike was up, but looking at leases, what are the square foots? Mike has a formula that's very similar to what we look at in his appraisals. Here's the roster, here's our loan terms. One thing we pay close attention to is that start and end date. You really want to try to match up maturities in commercial lending on multi-tenant properties. To pay attention to, do they have one anchor tenant whose lease is going to be up in 2 years, but I'm straying out there for 10 years, and I don't know whether or not that lease was entered into 10 years ago at a higher rent rate than what's really the market today. These are all things we're going to look at, and that's why those last two columns are very important. It's some risks that we're cognizant of, and that could impact value, and it could cause a lot of consternation for adjustments in the appraisals, et cetera, when we start looking at that stability of that rent roll. And then percentage leased. Then we're going to take that rent roll and we're going to plug it right into, like Mike did, and just run right through the CAMs, the operating expenses, come up with an NOI, and what do you do with it? Mike uses it a lot for valuations. We look at it for the debt service coverage ratio. And how much room do you have at the bottom? This one's pretty good. You're at a 1.4, 1.3, 1.47, 1.45. That's really good on income producing property. We're going to look at that and go, okay, he's got room to absorb vacancies, he's got additional increases in insurance expenses. That number being north of a 1.35, a 1.3 gives bankers a lot of comfort level, because we know he's got room in that property if there's performance issues to still keep making his payment. And there's really what it tells us. We do a break-even calculation that tells us, okay, what happens with vacancy, what happens with expense stressings, what happens when I do 20 years or 25-year AMs? Where do I get, and how much room do I have for this property to change over the life of my loan, and how comfortable am I? We also stress interest rates. What happens if it's a 1 to 2 to 3% increase in interest rates and that payment would go up? What happens to the performance of commercial real estate? As rates go up, in the ideal world, they're going to want a higher cap rate to, if I can have alternative investments that give me higher yields, and then what's going to happen is they're going to want to have a higher cap rate, which then is the inversion, impacts value down. So really, these are just the spreadsheets we're going through. I know Tom's probably here. I'd like to take some time there in the back of your book. If you have any questions about any of them, just pick up the phone and call me, and we'll walk through them. They are nothing more than an Excel spreadsheet that you can probably just go line item by line item with. I think that's it.
Do you do anything for that individual investor that's going to just buy a vacation rental property instead of like a 20-unit building that we're talking about here? Is that fall into your
Yes.
talking about also?
Yes, we do. We finance vacation rental properties, and it's a very similar analysis, but it's a lot easier.
What about if that property has never been used as a vacation ground?
Well, then we get into projections, and we get into pro formas, and we get into market comps, and let's go inspect that property, and let's create things. And most importantly, how do I mitigate the risk of relying on projections? Because it's going to take time to hit that market average. How many units are on the market? How many units are in that particular area? How stable is the cash flow? So what it comes down to is that personal spread. How much cash do they have? How much skin in the game do they have? And can they afford to pay me as I stabilize it?
Questions for Jeff? Okay, thank you, Jeff. That was very instructive.
Thanks, Brian.